Hi, Bill Beimers of SEQ Advice. Today I'm joined by Dr. Shane Oliver, Chief Economist of AMP Capital. And Shane, good to see you again. Our last catch up was during that dreaded period of COVID lockdowns and all that uncertainty at the time. But in reality now, looking back, that 2021 COVID recovery really translated into such a strong rally for global shares and real estate as well. Today, looking at the constant negative headlines we're seeing now and the inflation data, markets are obviously not comfortable with what we're contending with. And to add to that, central banks jacking up their official cash rates around the world. So Shane, what can we expect from here for the various assets and market sectors, and what should investors continue and retirees to continue to keep in mind?
Yeah, Bill, it's certainly an interesting time, and thanks for having me back on the video update. It did seem as if it was fairly unnerving the last time we did this, but of course, as you say, it turned out to be a good time in markets. Now, I guess to some degree, we're paying the price for that. We had very easy monetary policy, lots of stimulus from fiscal policy or government spending, and now, of course, we've got this inflation breakout, geopolitical issues with Ukraine, tensions with China, and of course, central banks raising interest rates aggressively, threatening recession. I'd have to say, for the very short term, things could remain quite volatile. We could see more downside in share markets. I know we are going through what is often a volatile time of the year. September, October often sees volatility in markets. We've heard from the Fed recently and other central banks, and they're all pretty hawkish, talking about more rate hikes, even basically saying that they don't mind if they cause a recession, given the desire to get inflation back down. And I can sort of relate to that. I grew up in the 1970s. Inflation wasn't very good. Certainly wasn't good for the economy, wasn't good for living standards, it wasn't good for investment markets. So I think we do need to get inflation back down. But whatever way you look at it, looks like we're going to see some more volatility, could see more downside in share markets in the short term. I guess, though, in my business and way of looking at things, I'm sort of getting on a bit, getting closer to retirement, and so you start wondering, what does this mean for me as an investor, and what does it mean for my eventual retirement? And I sort of come to the conclusion, well, if I look back through the history of these things, I just got to bear in mind that share markets do go through these rough patches every so often. We had a great year last year. To some degree, this is payback for that. The volatility you see in share markets is often the price you pay for higher returns out of shares over the long term compared to, say, having your money in cash and government bonds. If it was going to be super easy with no volatility, then your return would be very, very low. So obviously the volatility is the price you pay. I reckon, as I said, short term, more downside, 12-month view. I think inflation will end up, believe it or not, I think inflation will come down faster than central banks are allowing, because we are seeing supply chains get back into working again. We're seeing downwards pressure on some commodity prices. You can see that in the petrol price. I mean, there's issues there with the fuel excise going back on, but abstracting from that, the oil price is off its highs. So that suggests to me that central banks will be able to ease up on the brake maybe later this year or going into next year. And then as that occurs, and share markets are obviously a lot cheaper now than they were 12 months ago, investors will see value in there and markets will start to go back up again. So that's the profile I see. Short-term uncertainty, 12-month looking okay. But I think the thing to bear in mind through all of this, and me being humble, knowing that it's very hard to forecast these things precisely. So you've got to go back to basic investment principles. Bear in mind, share market volatility, as I said before, is perfectly normal. I've seen lots of these things through my career. Yes, they feel horrible, but ultimately markets recover and resume their rising trend. Secondly, selling out now is the worst thing you can do because you just lock in a loss and you won't get back in again until the market's fully recovered. So therefore you lock in a loss and you miss out on that upside. Thirdly, I think that the aim with all investing is to make the most of compound interest. That means sticking to a long-term investment strategy. And compound interest is basically longer term returns on top of longer term returns. That works best in growth assets like shares and property, not so good in cash and government bonds. So you've got to have that growth bias in there, but don't get thrown off by the cycle. The only other point I would really point out here, this is a very noisy world that we've come into. We're bombarded not only with the nightly TV or the newspaper, but on our phones. You get these news updates all the time. Or if you don't get it automatically, people just swipe on the phone until they find it there and read through the news. And inevitably that news is negative because you're not going to click on positive news. Most people just click on the negative news. So negative headlines dominate, and we're getting bombarded with that, which makes things feel even worse than they are. So I think very important to try and stick to a long-term strategy. That's what I'm doing with my personal investments, and turn down the noise, find other things to do rather than get too rattled by the negative headlines that we're seeing a lot of lately.
Yep, focus on the strategy and focus on the long game. Look, Shane, thank you very much for those valuable insights. Pleasure to catch up, and thank you for joining us.
Thanks, Bill. All the best.
See you again. Thank you.
Thank you for watching this video update. We'll keep these updates flowing through to our clients around Australia every few weeks with relevant content that we hope you find helpful and valuable. Clients of SEQ Advice are receiving these video updates by text as well as email, so I can confirm that the texts that you have been receiving from our team are in fact from us at SEQ Advice.